Let's take another look at weighted average cost of capital using a more interesting, sophisticated example of this Eastman Chemical Company. Welcome to My Finance Teacher. And before you look at this more interesting example of calculating weighted average cost of capital, I suggest you have a look at my previous video on the basics of calculating weighted average cost of capital. The link is in the description below. So let's say using Yahoo Finance, using Google Finance, or other sources that you'd like, you found some information about this Eastman Chemical Company where the stock price right now is, let's say, $52.99. The recent dividend that they paid was $1.76. The dividends are, let's say, expected to grow at 7% per year. And the company has 72,670,000 shares outstanding. Let's say we have a couple of sources for the company beta. Let's take an average between these two sources, either 1.92 or 2.01. Let's also say the market risk premium right now is, well, let's say 7%. Let's say the risk-free rate of return is, well, let's say 2.5%. And the tax rate applicable to this company is, let's say, 35%. Again, here I refer you to that previous video on the basics of weighted average cost of capital, where we discussed these formulas, which help you to calculate the cost of capital for the company when the company decides to raise capital by selling newly issued shares. So as you see, there are a couple of ways to calculate this cost of equity. So let's jump into them. According to the capital asset pricing model, our cost of capital is going to be equal to the risk-free rate of return plus the company beta, which, as we saw, is, let's say, an average between 2.01 and 1.92, multiplied by the market risk premium, which is the difference between expected market returns and the risk-free rate of return. And what this formula gives us is the cost of equity at about 23.3%. Next, looking at the cost of equity based on the dividend growth model, we're going to use this formula, where the next expected dividend is going to be 7% higher than the previous dividend, giving us the next dividend at, say, $1.88. And the cost of equity, according to the dividend growth model, according to this formula, is around 10.6%. Perhaps this is not the best example because the cost of equity, according to two of these different formulas, is drastically different, 23.3% versus 10.6%. Usually, if there are no mistakes in calculations, you perhaps would like to see numbers that are a little bit closer to each other. But in my case, the huge difference is because I took these numbers for the risk-free rate of return and the market risk premium just out of the blue, meaning that there is a good chance that the cost of equity, according to these two different models, differs wildly. In either case, let's just take the average cost of equity based on these two numbers, which is, let's say, 16.9%. Next, let's have a look at the cost of debt. And let's say you manage to find something like this table referring to the cost of debt. Let's bring it up a little bit. So what this table tells us is that the company has actually issued 5 different issues of bonds, all maturing, all expiring at different years. Let's say if this is the data for 2010, then there is an issue of bonds that expires in 2 years. There is another issue of bonds that expires in 8 years, in 14, and in 17 years. What you would do with this table is you would calculate the yield on each of these issues of bonds, and then calculate the weighted average yield on all of these issues of bonds. And of course, to calculate the yield on the bonds, we can simply use the formula equals rate. Let's come back to the formula in a minute. Before that, let's enter the numbers that go into that rate formula from the table in front of you. The numbers that we will need are the number of periods, the regular payments per period, the price of the bond, and the face value of the bond. So let's assume all of these bonds pay an annual coupon rate once a year only. And let's assume that the current year is the year 2010. Then the number of periods, in this case years until maturity, would be 2, 8, 14, 14, and 17 for these 5 issues of bonds. Let's also assume that the face value of all of these bonds is, just for simplicity, $1,000. In which case the coupon payments per period, which is in this example 1 year, is this coupon rate multiplied by the face value, which gives us $70 for $63, $72.50, $76.3, and $76 for these 5 bonds. The present value reflects the price. In this case, the present value is in percentages from the face value. Assuming the face value is, again, $1,000, our price is equal to $1,005, $1,040, $1,070, $1,000, and $1,015. The face value, again, I'm just going to assume $1,000 for each of these. Now what I want to calculate is the yield to maturity using this formula rate in Excel. And once you open the brackets, Excel will give you these hints of what's required for this formula, starting with the number of periods, then the coupon payments per period, the present value or the price, which is actually a cash outflow for those who are buying this debt. So I'm going to enter that with a negative value, and face value of 1,000. Now I can just copy this formula, and we could see a bit more details on this yield to maturity on each of these debts. Now I want to calculate the weighted average yield to maturity on all of my debt, where the weights are going to be the market value of each of these issues of bonds. I already have the market value in percentages, but say if I didn't have that, let's hide it for a moment. If I only had the market value in dollars or in millions of dollars, of course I could easily calculate the percentages by dividing each of these by the total. So here's the market value for each of these issues of bonds. We can have a look at the total and calculate our market value in percentages. Fix the reference to the sum so it doesn't move as I copy the formula. As you see over here, we get the same numbers, and I'm going to use these as the weights to calculate the weighted average yield to maturity. First, I'll multiply the yield to maturity by this weight, and then simply add up the numbers. The average yield to maturity on all of the company's debts before tax is around 6.8%. Next, we need to find the cost of debt after tax, where we multiply the cost of debt before tax by 1 minus the tax rate. With the tax rate being 35% over here from above, that gives us after-tax cost of debt of nearly 4.4%. Another source of capital for the company could be preferred stocks, preferred shares, and we've discussed those in the previous video on the weighted average cost of capital. Again, the link to that video is in the description below. For this example, let's assume the company doesn't have any preferred shares, preferred stocks issued. So we can proceed to calculating the capital structure between only common shares and debt. So let's look at our capital structure, starting with the market value of shares, which will be the number of shares outstanding, which was 72.67 million shares, multiplied by the share price of 52.99. And the market value of debt is already given to us in this table. Next, we will use the percentages of these dollar values as weights for the weighted average cost of capital. So let's have the sum and the percentages, where the weighted average cost of capital is equal to the cost of equity multiplied by the weight of equity in the capital structure, which in this case is around 73.3%, plus cost of capital raised through preferred shares multiplied by the weights of the preferred shares in the capital structure In this example, we don't have any of those. And plus cost of debt after tax multiplied by the weight of debt in the capital structure, which is in this case 26.7%. And finally, this formula gives us the weighted average cost of capital of 14.2%. I hope this example has been useful. Just one last thing to mention over here is that there is sometimes some conflict between the weighted average cost of capital for the whole firm versus the weighted average cost of capital for some of its divisions or for some of the firm's projects, because the level of risk associated with the whole firm might be different from the level of risk associated with some of its projects. Let's say, for example, we have a company with a weighted average cost of capital of 15%, and the company has several divisions, several projects, and it's also considering a couple of projects at the moment. Project A, which is relatively low risk, and let's say it's expected to have a return on investment of around 14%. If I disregard the level of risk associated with a particular project, I might incorrectly reject this project A, thinking that its expected return on investment is not high enough to cover the cost of capital for the firm. However, since the risks associated with this project are low, perhaps the cost of capital that I have to compare the expected return with should also be adjusted somewhat lower. Looking at the chart over here, we see the project A with expected return below weighted average cost of capital for the whole firm. However, project A is also located to the left side of the chart, meaning that the risks are relatively lower. And clearly, if I incorrectly apply a high cost of capital to a relatively low risk, I might also incorrectly reject this project, incorrectly thinking that the returns are not high enough to cover the cost of capital. And on the other extreme, we might have project B with relatively high risk and expected return on investment of around 16%. If I simply compare this expected return with the weighted average cost of capital without considering the risks of this particular project, I might incorrectly go ahead with the project if I don't appropriately adjust the weighted average cost of capital somewhat higher to account for higher risks. Looking at the chart over here, project B is further to the right side of the chart, indicating higher associated risk, and with the expected return of around 16%, which is slightly higher than the weighted average cost of capital. If I do not adjust this weighted average cost of capital up a little bit to account for higher risk of the project, I might incorrectly go ahead with the project. I might incorrectly accept this project, basically due to underestimating its risks. So even knowing how to calculate the weighted average cost of capital for the firm, there is a bit of finesse, there is a bit of art with adjusting this weighted average cost of capital for a particular division within the company according to the level of risk associated with the business of that division. So with this portion of food for thought for you, we are concluding this video. I hope you found these examples somewhat useful. I wish you all the best on your tests. And in return, I would really appreciate if you hit that like button and share the video with your friends. Bye bye.